thank you everybody for attending this first webinar of this Funds Week series. I see that we have approximately 4 different countries on the line, so that's very pleasing to see. A warm welcome from us at SPW, and I hope that you guys will find this presentation insightful, and hopefully it will give you great insight into with your clients' interaction afterwards. So today we have Malik Badji, the Managing Director, and Eric Keller, the Client Portfolio Manager from Robeco. Malik will give us a brief overview on the company, and Eric will give us a presentation on the Robeco Credit Income Fund. So some housekeeping. If you have any question, please use the box below and you'll be able to type your questions, and we'll endeavor to answer all your questions. But if time runs out, we will definitely come back to you with the appropriate answer. Well, without further ado, thank you again, Malik and Eric, for your time this afternoon, and I'll hand over to them. Thank you, guys.
Yeah, Omar, thank you so much for having us, and really appreciate the opportunity to present to everyone here. Good afternoon to everyone. I think we're probably all in an afternoon session somewhere around the world. My name is Malik Badji. As Omar mentioned, I head our Africa distribution business for Robeco, based out of the Netherlands, and I have my colleague Eric Keller, who's one of our senior client portfolio managers on our global credit team. And really delighted to speak to you all about something that we think is one of the more interesting and compelling solutions that we have within our platform here. But maybe before, because for some of you might not be familiar who Robeco is, maybe for just about a couple of minutes, let me give you a little bit of a sense of who we are, and then maybe we can then dive into the presentation. From a Robeco perspective, I mean, we've been in existence for over 92 years. History. So we have a long history, originally from Rotterdam. Our headquarters is in Netherlands, but the firm is significantly have a very strong global footprint, with offices in over 20 countries, and really a really strong pedigree in ESG investing, and also a very strong pedigree in credit investing, where we have a long history. We've been, as I mentioned, headquartered in Rotterdam. But the history of Robeco is essentially 2 levels. On the first level, for probably about 70 years of our existence, a large part of our product base and client base was based in Europe, with our core Benelux and core European market. But over the past 25 years, we are owned by a Japanese conglomerate called Oryx. But over the past 25 years, our business has expanded quite significantly globally. Eric, just on the next slide. And today, really what Robeco stands for, and I think it's important, out of the $200 billion of assets that we manage, and as I mentioned, with offices around 15 offices around the world, today we stand for 2, really core elements. One, sustainability. We have been a pioneer in sustainability investing globally. We've been investing in sustainability since 1995. And we have had a very strong DNA, and one of the only asset management firms in the world that has ESG integrated across our entire asset class. As I mentioned, out of the $215 billion of assets under management we manage, close to $196 billion is fully ESG integrated. So when it comes to sustainability, when it comes to investing in ESG, we have been the pioneers, and we continue to be the leaders. This has been affirmed globally, including with the UNPRI, which gives us the highest score of A+ across the entire asset class spectrum at Robeco. The second element is, which we're speaking to today, is on our credit history. We've been investing in credit for over 40 years. And really, from a global credit perspective, over the past 30 years, we've really been able to establish one of the largest and deepest teams in the global asset management world when it comes to credit investing. In fact, last year, Morningstar, which is one of the large rating agencies among funds in Europe, named us as the credit manager of the year. And the reason behind that is the strategies and the platform that we have, where we manage over $90 billion in fixed income, almost $50 billion in credit, has really been able to establish a strong platform across global credit, and really has been one of the key distinguishing factors of Robeco. What is unique about our global credit platform as well is that it's also fully ESG integrated. And one of the unique components of it is that we're one of the first asset managers in the world to have actually been able to look at SDGs, which is UN Sustainable Development Goals, and been able to integrate it into our investment process. So, and this is something that is unique, and this is a proposition that we want to speak to today. So simply speaking, we're delighted to be able to have the opportunity to speak to all of you. I'm more than happy later on into the presentation, if you have any questions on Robeco, to share further. But I think I'll stop here and I'll pass it on to my colleague, Eric Heller, because what we want to do is really spend this time really focusing on this unique proposition that we have. So Eric, off to you.
Yeah, thank you, Malik. And thank you everybody for taking the time to listen in today. Indeed, in the next 20 minutes, I want to discuss with you the SDG credit income strategy, which is a flexible global fixed income strategy aimed to provide an optimized yield and total return through the cycle. But as Malik mentioned, we are also a very sustainable house. So the aim of the portfolio is also to make a positive contribution to the 17 UN Sustainable Development Goals. And what we've seen is that also the implementation of this and avoiding companies that do clear harm on the UN Sustainable Development Goals also has an investment benefit to it. And we'll discuss that later. This is a flexible strategy, so we can invest in different asset classes globally: high yield, emerging credits, investment grade credits, financials, bank debt. And the flexibility allows us to really optimize the asset allocation through the cycle based on our top-down view. So as a team, we have a top-down view on where the economy will go, what will happen in global financial markets. And this also results into a certain asset allocation in the strategy. But where Robeco really has a lot of expertise as well is in the bottom-up selection of credits across the globe in the different markets, where we look at credits that are solid, have attractive yield and return, but also where we integrate ESG in the bottom-up assessment. So that is an important feature of this strategy. We want to identify the best credits globally to deliver an attractive yield and return through the cycle. The flexibility is also shown here. So this shows, what kind of sub-asset classes can we invest in. I think the message is this is a corporate credit portfolio, so we will primarily invest in corporate debt, but we do have flexibility to also allocate to bank debt, to emerging credits, and also use treasuries if we want to be more defensive. So if we expect more market volatility, we can allocate more to safe treasuries, and that's a way to create a resistant risk-return profile through the cycle. And the way to probably best, and sorry to go directly to a slide further ahead in the deck, but I think it nicely shows it. The flexibility of the strategy is really about understanding where are we in the cycle. So are we more in a bear market condition, which we saw last year in March, April, with a lot of market volatility. Then we want to be more defensive, so we'll allocate more to higher quality credits. We'll allocate to safe treasuries with the aim of reducing the drawdowns in the portfolio. If we are more in recovery phase, which basically also happened last year since April, May, where we see more opportunities when you can receive more outsized returns taking credit risk, we'll allocate to the different asset classes globally. So it could be emerging credits, bank debt, AT1 CoCos, or high yield. And the focus is really to optimize the yield on the portfolio and to optimize the total return on the portfolio when we see a lot of opportunities. And then once we get to a more, you could say, a second phase of the market, so when markets are very buoyant and have recovered quite strongly, which you might say is the case currently, we've seen a strong rally in financial markets, then we become more selective again. So we want to have a bit of lower risk in the portfolio, and it's really about selecting bottom-up the best credits in the different sleeves, but not take too outsized returns, as we do see that it's still pays to take some credit risk, but you have to be more selective. So the strategy is quite flexible through the cycle to really identify, given our top-down view, given where we are, what are the best asset classes to invest in, and what is the appropriate risk profile that we want to show. Then going back to the first part of the presentation, and so when we look at the characteristics of the portfolio, I think what is important to highlight is that the aim is to provide consistent yield and income through the cycle. So currently there's a 4% dollar payout of the fund, but the strategy also invests in primarily shorter dated corporate bonds. So typically the average maturity or duration will range between 3 to 5 years. We can even move lower if you are very bearish on the rate environment. And that is a very interesting feature because, especially in the current environment where US Treasury yields have risen quite a bit, we see that the strategy is less impacted by this rise in 10-year Treasury yields because of the lower duration of the strategy. So that's a very favorable feature, and it also allows us to reinvest in higher yielding opportunities that might present themselves. The other thing to highlight is also the quality bias of the strategy. So within this strategy, we can invest in high yield and emerging credits, but we will not go very aggressively down the quality spectrum. So we avoid investing in low quality high yields, so what we would call CCC high yields, where we think you are more sensitive to rising defaults. And the focus is on high quality high yields, so BB rated high yield, investment grade, and also higher quality emerging market debt. So when we invest in emerging markets, the focus will be mostly on large corporates. We invest in hard currency debt of larger corporates that happen to be based in emerging markets. So there's a clear quality bias in the strategy, which might be different from other strategies that more go aggressively down lower quality bonds. But we think, certainly in the current environment as well, where you might expect more companies to default as they've been hit by the COVID pandemic, it makes a lot of sense to have this quality bias in the portfolio. And then the other thing is that the portfolio also has a relatively low volatility profile or budget. So volatility ranges between 2 to 6%, which is very favorable and low compared to, let's say, traditional fixed income investments, but also compared to equities, where you have between 16 to 20% volatility. So it's a very low volatility profile as a result of the focus on higher quality credits, but also the lower duration profile of the strategy. And that's actually what we've also seen. So we've seen that actually, if you look at the risk return profile of the strategy, then we see that the strategy delivers, you could say, high yield-like returns when markets do well. So if you look at 2019, where the fund has delivered 14%, or last year 8%, which compares favorably to an outright high yield allocation where you are also invested in more lower quality credits. And at the same time, the drawdowns compared to high yield are substantially lower. And that is because of the emphasis on shorter dated credit and the quality bias that we have. But also very importantly, and we've not discussed it yet, is the sustainability part. And so, as Malik mentioned, the strategy aims to invest in companies that have a positive impact to the 17 UN Sustainable Development Goals. And so the UN Sustainable Development Goals, we consider them really as a blueprint for sustainability, so how to achieve sustainable growth globally, and they comprise both social, economic, and also environmental objectives. And so with the portfolio, we want to aim to have a positive impact to the different UN Sustainable Development Goals, but also very importantly, screen out the companies that have a clear negative impact on these goals. And to assess that, to assess what is the impact of a company, we have a three-step approach, where in the first step, we'll look at the products of companies. So the product and services, and how can we align them with the UN Sustainable Development Goals. And to give you two examples, if you look at a pharmaceutical company, we know how important they are. They make medicine, they develop vaccines, as we so hardly need now in the COVID crisis. So we can see that the pharmaceutical companies can make a positive impact on SDG 3, so good health and well-being, if you look at their products and services. And also, and there are some companies where you clearly see a negative impact. If you look at, for example, the alcohol companies, we might like alcohol, but in terms of health and well-being, they might have a more negative impact. And also when you look at, for example, a water utility, or you look at a bank, you can see that there is a positive link. Banks provide credits. They can help create growth in developed and emerging markets. And especially if banks are active in emerging markets, or if they provide a lot of credit to small mid-cap enterprises. And so also banks, if you look at their products, can make a positive contribution to the UN Sustainable Development Goals. But it's not only about the products that companies produce and services that they provide, but it's also about the way that they operate. And so to stick with the example of the pharmaceutical company, if the pharmaceutical company is involved in price rigging, opioid scandals, then the way that they operate could still violate or do harm to the UN Sustainable Development Goals. So they don't make medicine broadly accessible for a lot of people. Or if we stick to the example of banks, if the bank itself is involved in mis-selling of products, in perhaps anti-money laundering scandals, then the way that the bank operates means that, there's still a negative impact on the UN Sustainable Development Goals. And the last step, and that is that we also want to check for controversy. So if we do see that companies are, despite the fact that they might make products that do well, but are involved in controversies like environmental spills or fraud, then obviously those companies we also do not want to invest in. And so what we've done is we've assessed all the companies that we cover as a global credit team across high yield, emerging markets, and investment grade markets. And roughly 22% of the companies received a negative assessment. So these are the companies that, based on the product and services or based on corporate behavior, do clear harm to the UN Sustainable Development Goals and are therefore not eligible for this global fixed income strategy. But still, a lot of companies remain. So 62% received an outright positive assessment and 16% a neutral assessment. So there we don't see harm on the UN Sustainable Development Goals, but there's also not a clear, strong positive impact. And the good thing is here that despite the fact that we do screen out the companies that, that have a negative impact, the universe is still large and diversified enough, and we can invest in a lot of different markets, that there are enough names to invest in and where we can optimize yield and return for our investors. But we think the screening out of negative companies with a negative assessment is very important, because what we've seen, and this is an experience that we have as Robeco for a long time, integrating sustainability and ESG in our credit strategies, is that we have found that avoiding companies with a clear negative sustainability profile or negative impact on the SDGs are also the companies that operate with old school business models. So we can think about energy companies that heavily rely on fossil fuels and where you have the issue of stranded assets, utility companies that do not transition to more renewables, but also, of course, if you look at some tobacco companies or automotive companies that do not transition to lower emission or electric vehicles, we'll see that the companies operating with these old school business models will see more pressure on revenues and therefore also more pressure on their credit quality. But also indeed, if you look at companies that in the way that they operate have poor corporate conduct, and we've seen in a lot of cases that is a leading indicator of more problems down the line, being it fines or more regulatory interventions. And so also these kind of companies we want to avoid. And what is interesting about that, and we'll talk about the impact, but what we have seen is that there is a relationship between companies operating in areas and sectors with a negative, which do harm to the SDG. So with a negative SDG assessment, those companies are associated with lower returns, higher volatility, because we do see more downgrades, defaults for these companies, as opposed to companies that have a positive SDG assessment, which basically provides the product and solutions and operate to best standards and are aligned with the UN Sustainable Development Goals. And they've been able to deliver higher returns and lower risks. If you look at a history of 10 years for both the high yield markets as for the investment grade markets. And also in the life track record of this strategy, we've seen that avoiding companies, especially when markets are volatile, avoiding companies with a negative SDG assessment helps to limit drawdowns. So the favorable risk return profile that we're able to generate, also compared to high yield, is also a result of the sustainability screening. Now, the portfolio itself will have a broad exposure to the different sustainable development goals. And here we show the exposure to the portfolio in blue to the different sustainable development goals compared to the broader reference universe in orange. And so within the portfolio, we take out the companies that have a negative impact, but then we want to implement investment themes and invest in companies where we think that can generate attractive financial returns. So the exposure to the different sustainable development goals is also a reflection of where we see investment opportunities. And so, for example, currently in the portfolio, we have a substantial allocation to bank debt and also to debt issued by communication companies. And these companies can be linked to SDG 1, 8, and 9. So the no poverty, decent work and economic growth, and industry, innovation, infrastructure. And you will see a higher contribution to those companies. But we're also exposed to some of the healthcare companies. And you therefore will see a higher impact on SDG 3, good health and well-being. And finally, what we see is also that we are identifying companies that score better on the environmental metrics. So if we look at affordable and clean energy, SDG 7, or climate action, we see that the portfolio scores better than the overall index. So we want to aim for broad-based exposure to the different sustainable development goals, but it is also a reflection of where we see the underlying investment opportunities. So yeah, that is about the sustainability part. But as said, first and foremost, it's also about creating an attractive income for our investors. And I think we've shown that we are able to do this. And this is also underpinned by a strong global credit team. So Robeco has a long track record in global credits. We launched our first high yield fund already in 1998 with a decade-strong track record in both global investment-grade credits and emerging credits. And it's all because of the experience of the global credit team. So on the left side, we'll see the lead portfolio managers for the strategy, Victor, Reinout, and Evert. And on the right side, they are supported by a large credit analyst team that have a sector focused, so they are specialized in a sector, being it financials, automotives, or other sectors. And what is important that they have a global view. And this is, we think, what makes our team very successful, is that we don't have silos between Euro or US and emerging. No, we look broadly across the market. So within financial sector or within the automotive sector, the analysts will source the best ideas across the US, Europe, and emerging markets. And this allows us to really identify the best opportunities, but also compare developments between markets within a sector. And this has resulted in a very strong track record. And the other important point is that, yeah, you can see the sustainability team below, 37 people. So at Robeco, we're in a unique position that alongside a very strong global credit team, we have a well-resourced and experienced sustainability team, which you could say we have broadly two teams. We have an engagement team, so we engage with companies to help improve on different sustainability topics, ranging from biodiversity to improving corporate governance. And also we have an SI research team that provides valuable input for the credit analysts and has helped us to avoid to really have better, use this sustainability information to have better view on downside risks in credit markets. And we've seen that for our global credit strategies, we've had no defaults in the last 10 years. So the strength of the credit team and also using this sustainability input has been very, very important. Now I'm aware of time, so what I will do, I will skip to the current portfolio positioning. Or let me just actually give you one example of how we look at a company from both an SDG alignment perspective and a credit fundamental perspective. And here we've taken the example of Star Energy, which is an Indonesian utility company. And for utility companies, what is important, we look at the proportion of renewable energy in the overall mix, and that needs to meet a certain threshold. We also look at emerging market exposure, and we want to assess if a company is exposed to coal, nuclear, if they have expansion plans, and we'll also look at the carbon footprint of utility companies. And specifically, this company is scoring very well. They are fully renewable based because they generate electricity through geothermal energy. And they are also primarily located in emerging markets, so they receive a very high assessment in the framework. But the SDG analysis is not the only thing to look at. We only want to invest in this company if we see valuation upside, if we see attractive financial returns. and if we're comfortable with the credit story. And that is the lower part where we look at where we make the assessment. This is a BBB company. We make a fundamental assessment. We look at relative value, and we'll only invest if we are comfortable with the credit fundamentals and if we see enough attractive valuation upside. And so that is important. We will not just invest because it has a positive SDG alignment. We'll only invest if it also has an attractive risk return profile. So when we look at the current portfolio, and I think a few highlights to make, and some I already mentioned, is that if you look at the current portfolio, and we can look at the sector allocation later on, but I think what is important to highlight is the two, if we look at interest rate risk, I mentioned it already, and I think it's especially relevant in the current environment. It has a low duration profile, so currently 3.3 years, which is significantly lower compared to other traditional global credit strategies, and helps to insulate the portfolio from rises in interest rates. But also the fact that we invest in areas of the market that are less sensitive to rising yields. So for example, we invest in BB high yield, higher quality high yield, short dated, less sensitive to rising yields. We like bank debt, and banks, of course, are beneficiaries of rising rates and a restart of the economy. And we also hold cash in the portfolio, and the focus on shorter dated debt means that we can quickly reinvest proceeds into higher yielding opportunities. So that makes the portfolio quite flexible, and the portfolio can navigate quite well in a volatile and a rising interest rate environment. And the other things about credit risk, we think at this point in the cycle, you do want to be more cautious because we do expect defaults to rise, despite the fact that economies will rebound. But we've seen lower quality companies that will have to refinance themselves at higher rates, that are operating in areas that have been more hardly hit by COVID. And so we think this quality bias is quite important to protect the portfolio from downside risks. And yeah, we do see still opportunities in global credit markets, especially in areas that have been hit by COVID, where we do see that corporate bonds are still trading at a premium. So the automotive sector, leisure lodging, so hotels, for example, where we still see opportunities and they will benefit from a further reopening of the global economy. But also bank debt, we think, is still trading at a premium. We like selective bank debt in Europe, especially, where we will also see that banks are benefiting from a reopening of the economy and a rising yield environment. And more recently, we've been increasing the allocation to emerging credits. So there also we see still bottom-up companies that offer attractive premium compared to the broader credit market. And so if you look at the current allocation, it's you could say that we have still a decent allocation to investment grade, higher quality credits. This includes also 10% allocation to T-bills, to cash. High yield, where we see opportunities, especially in the BB space. And selectively, we are invested in emerging markets, so larger companies in, for example, Brazil, China, and Mexico, where we do see still interesting upsides. We will typically not invest in local currency debt, so we do not want to take currency risk in this portfolio. It is about mostly hard currency, so euro or dollar denominated bonds that we want to invest in. And if you would look at the current sector allocation, yeah, we do see still the preference for financials in the current portfolio, alongside, I would say, a decent allocation to consumer cyclical. So there we see automotive companies, hotels, where we think there's still value. We also like the basic industry capital goods, so anything from paper packaging companies, chemical companies, that can also benefit from recovery of the economy, rising commodity prices. And where you will see a lower weighting typically is on the energy sector. And that has also to do with the fact that a lot of the traditional energy companies, given their high carbon footprint, will score less well in the framework. We can still invest in energy companies, but mostly the ones that are primarily involved in the production, storage, and distribution of liquefied natural gas, which is seen as a lower emission source compared to, for example, oil. So yeah, we do see the focus there on more these natural gas energy companies. But so currently the allocation is somewhat lower, as we've been taking profit on these positions by the end of last year. And I'm cautious for the sake of time, and I do want to leave it open to questions. So actually, it might be good because I think I did highlight, and so here we do show the performance. So this strategy was launched in in May 2018. We're almost nearing the 3-year track record, but the global credit team, if you would look at the standalone track records of our emerging credit capability, our global credit capability, or our global high yield capability, we have a very strong track record by this team in primarily because of their strong bottom-up credit selection skills in the different markets.
Eric, maybe the size of the fund as well currently?
Yeah, so the size of the fund is currently 1.4 billion. And so, yeah, we've seen quite some uptick. So investors like it for their flexibility, for the sustainability, but also for the fact that it is higher quality and lower duration, which makes it interesting. And overall, if you look at the broader assets that we have in SDG credit strategies, we have different flavors. We have more than 6 billion. And the credit team as such manages 40 billion in global credits, but the fund itself is currently $1.4 billion in size. So I want to actually stop here and open it up to questions, perhaps on the portfolio or the outlook or the sustainability screening that we apply.
Thank you very much, Eric. That was really insightful, especially like the when you spoke about the SDG framework. We do have some questions. So the first one that I wanted to ask you is, how does the SDG matrix impact the strategy in terms of risk management in the fund?
Yeah, that's a very interesting one, and that's why I wanted to highlight this the chart that I showed at the start. So where we do see that there's a positive relationship between companies that clearly do harm to the SDGs and their risk and return profile. So, and this, of course, is over a longer period, and there we look mostly at sector levels. But I think what is interesting to see is what we saw last year as well, and I think we've had a good test case or stress test if you look at the sell-off in March last year. And we can nicely compare our SDG credit portfolios with the index, with a global index, or with our non-SDG global credit portfolios. And what we do see is that avoiding energy companies, but also banks that due to bad corporate conduct received a negative assessment, utility companies with a negative assessment, these were also the underperformers in the COVID-induced sell-off. So we do see that when there's a lot of volatility in markets, the companies with a negative SDG assessments do underperform. And you might say, well, does that mean that if we see rebound in markets, that's completely then the reverse? No, it's not. So if we look since the inception of the strategy, avoiding these companies does contribute also over a longer period of time. So it reduces the drawdowns when we see a lot of volatility. And it still contributes over the lifetime of the strategy. And this is an experience that we've had already as we've integrated not so much SDGs, but generally ESG factors in our bottom-up credit selection for all our credit portfolios over the last 10 years. And we've seen this provides a lot of additional insights in where potentially risk for credit investors could resurface. And so we think it's a very valuable additional way. And you might also say, well, companies that do not care about the SDGs, or that don't care about the carbon footprint, carbon policies, or new regulations that might be unleashed because of this, are also the companies that will face more regulatory pressure, shifting consumer demands, or problems refinancing themselves if investors are really more cautious with these kind of companies. And so that is something, something we clearly have seen. So we think it's an additional mitigator of risk, but aside from that, obviously we do a lot of additional risk management in this portfolio to make sure that we stick to this volatility budget. We allocate the volatility budget depending on our top-down views. So risk management is definitely an important element in this strategy, but the sustainability screening can assist there as well.
Great, thanks for that answer. The second question I have is, and it's maybe more to Malik. What differentiates, and you touched on about it a little bit at the beginning of the presentation, but what differentiates Robeco against its peers?
Yeah, thanks for that. I mean, it's a very good question. I mean, and from our perspective, essentially what has distinguished us over a period of time is essentially three things. one, obviously, as we mentioned, the pedigree we have on ESG investing, it seems that it's the new phenomenon. There's a lot in the market right now on ESG and trends. And you're seeing a lot of proliferation of products and solutions around that. But we have been in the industry and we've been investing from an ESG practice over 25 years. We've been able to really test it, pilot test it, and run it. And we've actually been able to deliver, similar to the SDG fund that we have here, where we've been able to deliver returns and also have a strong ESG emphasis. So from a credibility perspective, simply speaking, we're one of the best in from an industry perspective. The second element, and I think it's very important that Eric mentioned that, and Eric probably go back on that credit team, is that we have one of the strongest and deepest depths when it comes to investment teams at Robeco. We have that platform where every investment idea is well researched. And what we've been able to do throughout the firm is really be able to establish and set up a very strong and very diverse investment team. So out of the 900 employees we have, almost a third of it are investment professionals. That shows you the emphasis that we have on research, on depth of understanding on the markets we have. So from a credibility perspective, particularly around the teams that we have, particularly in credit, we have one of the deepest and the most diverse teams across the board. So strong ESG capabilities and credentials, and a very strong platform in terms of our products and our research platform.
Great, thanks, Malik. Thank you for that. I think we have time to have, let's say, 2 more questions, and the next one would be, so is there the right time to invest?
Yeah, a good question. And indeed, we have seen quite a strong rally in financial markets already, and discounting a lot of the positive news about rebounding economies. So yes, we do see that valuations are more compressed, but 2 things to say to this is that, first of all, this is the nice feature about this strategy, that we do have the flexibility to allocate to different asset classes within global credit markets. So even if overall spreads are compressed, we can still search for areas of the markets that have not fully repriced or where we still see value. And the other thing is also that, so the flexibility is there, definitely something that is very interesting. In that sense, we would consider this more an all-weather allocation, where we will allocate where we see the opportunities in the cycle, and also focus more on drawdowns protections when there's more market volatility. The other thing is that the fund itself, the base currency and exposure of the fund is to the dollar and to US rates. And so you could say with the rise in rates, ultimately the yields are also increasing. So that in itself, and as said, we do have the ability to, because it's short dated, we can reinvest in higher yielding opportunities that we see. Now, overall, we have to be honest, we are less bullish than we were half a year ago. We've seen quite a repricing in markets already, and we might actually see a bit more volatility short term. But I think this strategy, I mean, it's always difficult to exactly time. So with this strategy, I would say it's a longer term allocation, where we do the allocation and where we can adjust the opportunity set. And so even if we would see more volatility this year, then we can shift the allocation appropriately in the strategy. But we think the rising yield environments does make the yield proposition more interesting going forward.
Fantastic. Thank you for that. And then one last question that came from the audience. Would there be a slide on your top 10 holdings? Yeah. And whether you can speak a little bit about that?
Of course. And we have that, of course. And so first of all, let me, so if we look at the top 10, this is a diversified portfolio. So the overall portfolio, I think it's on the next slide, is invested in over 160 different companies. And what we show here are the top 10 positions in terms of active risk. So there we not just look at market weight, but we also look at duration of the position and the spread levels. And so I would say the top 10 is a combination of different exposures. So we have, the Rabobank it's a Dutch bank. So there we invest in the subordinated debt. We still like the prospects for bank debt, given the spreads are still attractive, but also the fact that banks will benefit from a more rising rate environment. And so another bank that you can see in the top 10 is BBVA, as a Spanish bank. So within the banking exposure, we have a combination of Spanish banks, some small banks in the UK still, and also banks in the Netherlands and Austria. So we don't like necessarily all the banks in Europe, but we do like specific banking markets in Europe, and we still see value in those parts of the market. Then I would say last year we've been increasing allocations to communications sector. So you might see Charter Holdings with the US company, Gas Capital, which is a Chinese communication company, but also Cellnex. It's a Spanish wireless telecom operator. So they operate the towers that transmit the 5G signal. And so we do like these companies because also there we are able to invest in solid BB rated names. We buy the shorter dated debt typically, and these companies are also still trading at a spread. And overall, this is a relatively more stable sector, so less susceptible to the cyclicality in the economy. Intercontinental, so this is an example, and also ZF. So ZF is actually the largest automotive part producer in the world, and they're based in Germany. And so, yeah, this is really, you could say, a position that we have alongside the position in intercontinental hotels, where we see that automotives, hotels, they still have what we call a so-called COVID premium. So they're still trading at elevated levels compared to pre-COVID, as investors were concerned about the impact of the pandemic on these companies. But we do still, they will benefit from a reopening and restart of productions, and there's still value in these specific names. And then you can see one of the energy companies, Enterprise Products Partners. This is an example of an energy company that is eligible from an SDG perspective because they are primarily active in the production and storage. It's a US company of natural gas, so they have significantly lower emissions compared to traditional energy companies. And so they are eligible in this portfolio. And the last banking name is EIB, that's Allied Irish Bank, so an Irish bank where we've seen a bit of premium around Brexit risk, and it's still trading at a premium. So this is also a very interesting addition to the portfolio. But these are just the top 10 names, so the whole portfolio is diversified across 160 different names. And so we can find enough names within the SDG eligible universe to invest in.
Well, thank you very much, Eric. And
you're welcome.
And yes, if I think we will end off here. So I'm going to say thank you very much for both of your time, to you and Malik.
Sure.
And I personally found that the presentation was very interesting, and it was good to have you guys present for us. And as a reminder, if you guys have any more questions, please do email me, and I will make sure that I answer them. And if I can't, I will find the answers. As a reminder, the next presentation will be on Monday on the Sanlam Multi-Strategy Fund and the Sanlam Real Asset Funds at 3:30 Central Africa time. So for now, I hope you guys will have a good weekend, and
Same to you.
And thank you again.
Thank you very much, and have a great weekend. Thank you for inviting us. We hope you're well.